And there's a couple reasons that underlie this, right? So despite the fact that managers focus on trying to capture revenue growth, it ends up being not a very effective way to generate growth. And that's for a couple of reasons, right? So let's talk about it in terms of this market here that we've got described. So here's a pie chart showing the market for cell phones, right? So this is a really early picture of the market. This is 2008. And I did that specifically because, of course, it would look a lot different now. 2008 was just a quarter. This was, 2 quarters after the iPhone came out. Okay, so the iPhone barely gets released in the very beginning of 2007, very end of 2008. And so the biggest phone company, cell phone company in the world at the time was Nokia. Then you got some Samsung phones, you got Sony, you got Motorola. They're all flip phones, stuff like that. iPhones is crammed here in this other category. And of course now the market looks totally different. It's probably predominantly iPhones and Samsung with a little slice of Google and Microsoft and these other phone markets, right? So when we're talking about the market, right? If this is the size of the market, then portfolio momentum means the pie is getting bigger. So the circle is getting larger, right? If I'm buying a company, then Nokia is just buying Samsung's share. So Nokia's share of the market is getting larger, but it's only getting larger not because they're adding new customers, but just because they purchased Samsung's customers. But market share competition means that I am trying to increase my slice of the pie. And maybe by looking at the pie, I hope it sort of indicates to you why this is not as successful a strategy, right? So there's a couple of reasons why, despite managers really being gung-ho about capturing market share, you can see why it's not going to be a very good long-term strategy, right? So the biggest reason it's not a very good long-term strategy is because it's a zero-sum game. And that means that if Nokia wants to capture more of the market share, it has to come from somewhere else. If the market is not getting any larger, if the pie isn't getting bigger, the only way for Nokia's slice to get bigger is to take it from someone else. So if they take it from Samsung, right, then that is very likely to cause retaliation. Okay, so the first reason why market share competition isn't really great is because it engenders retaliation from whoever it is that you've captured market share from, right? The second reason is that if you've then captured some market share, so Nokia has taken some of Samsung's customers through market share competition, and we'll talk about some methods of market share competition, but one of them might be like, we offered a bunch of discounts, right? So we offered a bunch of discounts. We took some customers that were normally Samsung customers. They retaliate, and what happens in the long run is it's not sustainable because it's mostly just a one-off thing, right? If I have offered a bunch of discounts to try and steal some customers, compete away some customers from my competitors, they are not just going to take that sitting down. They're going to retaliate. It's unlikely that this is any kind of sustainable growth. It's just going to be a one-time thing, right? So neither of those two reasons are are predictive of market share competition being a really strong driver of growth for the firm. And then the last one is that ultimately, or the last big reason why market share competition isn't very effective is that ultimately every mature product has a sort of total market size, right? At some point, there is going to be no more growth in the market, right? So at some point, all the cell phones that have been sold, or everybody that could be sold a cell phone has one. And so the market for cell phones is saturated. And so competing for market share becomes the only sort of way to get anywhere, and there isn't any then we run into these first two problems where we are just going to be retaliating against each other, and there's no room for any more sort of natural organic growth. Okay, so despite it being something that's focused on, it is just historically not a very good idea to try and create growth by competing for market share. You are much better off focusing on trying to generate some portfolio momentum, or even making a purchase of one of these other companies rather than trying to compete them into the ground, right? So Nokia would have been better off trying to buy Samsung's cell phone business rather than trying to compete it away. Because ultimately, this, as we'll talk about, this kind of competition ends up being bad for the whole market. Okay, so then before we get into talking about the strategies that generate growth through each of these channels, we should spend a little more time talking about growth and what we mean by growth and how companies should be thinking about growth. And mostly what I want to get across here is that we can't, it is very tempting to talk about growth at a firm level. So for instance, I would talk about Samsung's growth here at a firm level, but we have to remember that Samsung is not a phone company. They are a massive conglomerate. They're the biggest company in Korea. They make all kinds of things under the sun. They make everything. They're like everything from a drug company to to a phone company to they make cars and heavy machinery and stuff too. So they make just all kinds of things. And so we can't really sit there and say, oh, Samsung's growth was 7%, because that doesn't, if we're talking about the cell phone market, that doesn't have any reflection on what the actual growth in the cell phone segment of Samsung's business was. Okay, so we need to disaggregate businesses so that when we're talking about growth, we're talking about the growth of the actual product market that we're interested in. Now, for some firms, of course, they only operate in one product market, so that there's no more granular level than that. If all I do is make phones, I don't know a lot about Nokia, but let's say Nokia only made phones, then we're just fine talking about Nokia's total growth in terms of the phone market. However, we do oftentimes want to disaggregate that even farther and talk about growth in terms of geographical market segments. So Nokia might have great growth in Europe, the European phone market, and poor growth in the US market. And so the management team might be wanting to look at different strategies in different geographic markets. Certainly they're going to want to be doing different strategies in different product markets, right? So if you're Samsung and you're operating the phone market and the phone market is pretty saturated, there's not a lot of room for organic growth, then now you may be trying to compete for market share with Apple. And that might be a viable strategy at that point for the phone market. Probably isn't a viable strategy for your medicinal drug business. So you're going to need to talk about different strategies for different products. And certainly you're going to have different strategies for those products across different geographical segments. Okay, so we want to understand growth at a very granular level. This is one of the places where we may not have as much data if we're outside the firm. Okay, so at least in the US, firms are required to do what's called segment reporting in their financial statements, but firms are allowed to choose their segments, meaning they can report what they think is material to the firm. So Apple, for instance, reports their electronics business, so phones, computers, all that together. And we would probably, if we were like thinking about investing in the firm or buying the firm or something like that, we would want a more detailed breakdown of those product market segments. That's not usually available to us outside of the firm. Of course, if we're consultants for McKinsey or we're the management team itself, then we do have this level of granular detail, and we can go as deep into the data as we need to go. Okay, so this is just something we really got to be conscious of, particularly for growth when we're talking about strategies for growth, that it's going to be different for different things.